Hey there, welcome to 3 Minutes with Jay. Jay Bala, our portfolio manager out at AIP Asset Management in Toronto. Jay, let's just jump right in. The markets just keep going up.
Absolutely. I mean, I guess they found two fresh catalysts. The first one, of course, is the tax cuts, and it's looking like they could probably get something done. It's probably not as good as everybody thought it would be, but it's still good. So I think that's sort of your catalyst. On top of that, you're kind of, in that seasonal period where the equity market traditionally goes up, sort of the last, few months tend to be generally good, sort of the, late October, November, December period, sort of the pre-Christmas rally, if you will.
I saw this morning, Caterpillar's numbers were excellent, and my knowledge of the world of investing tells me if industrials are doing well, how much could we be looking at another 12-month run here in the markets without saying a black swan event coming up like we talked about last week? But, if industrials earnings are starting, 3M the same this morning, they blew through earnings. What surprised me about both of them was it wasn't just the earnings, the revenue was way higher than the market predicted. And, in the past I've seen earnings be great, but it's because the company did a lot of cost cutting. This is revenues higher, earnings are higher, and that was a real catalyst today for the market.
Well, I mean, there's sort of a bit of a catch in this. I mean, you got to keep in mind in the last 3 months, the US dollar has depreciated a lot, right? So if you compare it to the Canadian dollar, I think that's the way we always look at it, is, the Canadian dollar 3 months ago was somewhere around 73, 74 cents. But by the end of Q3, it was sitting around 80 cents, which means, the US dollar had gone down 7 to 10% over that period of time. So if you look at Caterpillar's revenues or anybody else's revenues, a lot of that stuff comes from international markets. So you don't have to sell more product. You're just there because at the end of the day, if you're selling XYZ bulldozer in London or in England, I mean, you're getting paid in pounds and you're not adjusting that price just because the dollar came down, right? So you got to be a bit careful on that. So, you got to be able to strip out sort of the FX variance because that impacts investments a lot more than people think, right?
Right. So that's great. That's a great point. So really, when they reported their earnings, it really all depends on what day they did a currency back to the US dollar, right?
Yeah, basically it's, they probably averaged it out, but yeah, I mean, they don't even actually have to physically convert it. It just kind of gets accounting kind of converted, right? So you just do an FX rate at whatever spread you have. But I mean, if your currency depreciates 10%, in theory, if you have 100% of your revenue from outside, guess what? Your revenues just went up 10%, right?
So Jay, what's the strategy for AIP then?
Yeah, we've started allocating a bit more to the equity markets. On the bond market side, I mean, we're still on the shorter duration bonds. We're still of the opinion that, interest rates are going to continue to go up. And just being in a long-term bond, 10, 20-year bond at this time it's virtual suicide, right? Like it's like the worst decision you can make.
All right, awesome. Thanks, Jay.